Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, we're talking about capital gains distributions. It's that time of year. I don't know if I would call it the giving season in this sense, because whether or not we like it, a lot of mutual fund managers out there are going to be compelled to distribute taxable capital gains to shareholders. And if you own mutual funds in one or more of your taxable investment accounts, it might be something you want to pay attention to. So this week on the podcast, we talk about why mutual funds are required to distribute capital gains to shareholders, what it might mean for you, and a few things that you might want to consider doing about it if you're about to receive a taxable capital gain yourself, because it will absolutely impact your tax bill, again, whether we like it or not. I hope you enjoy it. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. Alrighty, so today on the podcast, I want to devote the time this week to talking about capital gains distributions. Because as I record this, we're in the first week in November, and this is the time of the year when we start to get estimates from mutual fund managers about what they will be distributing from their funds to shareholders between now and the end of the year. And the reason that this is important is that, as you might remember, if you've listened to the podcast for quite a while, perhaps you remember this. I think I've talked about this in the past. Although we've done over 100 episodes of them at this point, I'm starting to forget exactly what we did and didn't talk about. But at any rate, mutual funds are required to distribute capital gains in the portfolio pro rata to shareholders at the end of the year. And for those of you out there who are investing in mutual funds in taxable investment accounts, either in your name or maybe jointly with somebody else, like a spouse, in the name of a revocable trust, something like that, then you might be employing some tax strategies where you really want to closely follow where you think you're going to be at the end of the year taxable income wise, especially when this comes to harvesting long-term capital gains you might have, Roth IRA conversions, your mandatory distributions if you're 72 years old or older, or if you have an inherited IRA perhaps. There are all these really good reasons that we just kind of want to keep our finger on what our tax situation is going to look like between now and the end of the year. And on top of that, if you're invested in one of these mutual funds in a taxable account, if you're not paying attention to this, you might get a big, unexpected, unwanted distribution that's taxable to you, either as a short-term or a long-term capital gain. And so the way this works from the mutual fund side of it is that the mutual fund managers are required to distribute gains through the end of October of each year. And so being that we're in the first week in November, the month of October has already closed. Mutual fund managers are going through their books and portfolio accounting and determining how much they're going to be compelled to distribute back to shareholders in the form of long or short-term capital gains. Those estimates will start to come out this week. We've already gotten, the first batch of them. Morningstar is pretty good at reporting on this kind of stuff. We will get more by the time that this episode goes live, and the distributions will start to hit investors' accounts through the end of November and through the entirety of December. So I thought we would spend the time on the podcast this week talking about why mutual funds have to do this and what you need to be paying attention to as an investor to make sure that you don't receive this big, fat, unwanted distribution and corresponding tax bill between now and the end of the year, because that can blow up the whole calculus and math problem of your Roth conversions or other mandatory distributions you might have, because we pay more, or because we pay a higher rate of tax at higher levels of income, it just means that it might result in a larger tax bill than we could probably manage around otherwise. So let's start from the beginning. And like I say, I think I've probably talked about this on the podcast in the past. Forgive me if this is a repeat for longtime listeners out there. But let's cover exactly how mutual funds are structured in the first place and why they're a little bit different than exchange traded funds. In a mutual fund, when you buy shares of this bad boy, you're giving cash to a mutual fund manager. That manager is not going to give you shares in return for your cash until after the end of the trading day. And what that means is every day, the mutual fund manager is required to calculate what the net asset value of their portfolio is. So let's say let's use the example that you're buying a Russell 2000 small cap US stock index fund, or a fund that tracks that index, excuse me. So if you have $1,000 and you give it to the mutual fund manager and say, hey, I'd like to buy shares of your fund, what they're going to do is wait until the end of that trading day. They're going to total up what the total value is of the portfolio. So they take the value, close of business that day, multiplied by, or based on the number of shares, the total size of the portfolio, they divide it by the number of shares outstanding, and that's the net asset value per share. And then they're going to give you a commensurate number of shares in exchange for the cash that you gave them earlier in the day. So if you gave them $1,000 and the net asset value that day was determined to be $100, then you're going to get 10 shares of that mutual fund. Now let's elaborate on the example by a little bit. Let's say that there are 9 other investors in this same fund. They all hold 10 shares each. So that it's yourself and 9 others for a total of 10 investors. There are 100 shares of the portfolio that exist. Each of the investors holds 10 apiece. Well, what happens is the value of that portfolio is going to go up and down throughout the year. And I think it's every quarter the Russell reconstitutes, meaning that some companies are dropped from that list in the 2000, other companies are added to that list of the 2000. And the mutual fund manager is going to be required to buy and sell stocks every time that list is updated every single quarter. That triggers capital gains and losses. So think about that for a minute. You have 2,000 companies in the portfolio that the index fund manager is expected, required really, to keep in the portfolio. And then every single quarter, that list of the 2,000 companies they're required to keep in the portfolio changes a little bit. Some are added. Remember, this is a small cap index, so some of them might grow to be medium or large size companies and are dropped from the index. Other companies that were formerly really big companies may have come on hard times and fallen in value and be added to the index. So if you're the manager of that fund, you're required to sell the companies that are dropped from the list and buy the companies that are added. And when you're selling companies that have been dropped from the list, that means that you're triggering a taxable event. If they've gone up in value, then you're probably going to have a taxable capital gain, long or short term, depending on how long the portfolio has held the position. The positions you're buying added to the portfolio, establishing a basis and a time period to use going forward as far as whether they're long or short term capital gains. So whenever you have these taxable events in the portfolio, whenever the mutual fund manager is required to sell securities, and I'm using the example of an index fund where the manager is required to buy the exact list of securities that's coming from Russell Investments, which is the producer that licenses these lists. In active mutual funds, where the mutual fund managers have more discretion about what to buy and sell, active funds do tend to distribute larger capital gains over time than index funds. but they do have more discretion over holding periods and therefore a little bit more discretion over whether sales will trigger long-term or short-term capital gains and when they might be triggered in the first place. But at any rate, that's basically how it works. You've got the manager of the mutual fund that's taking you and the 9 other investors in this example, taking all their cash, buying securities, selling securities in the portfolio every time there's a sale that triggers either a long or short-term capital gain. So all of that activity from November 1st of the previous year through the end of October of the current year, I believe it's the beginning of November for the previous year, but at least for this year through the end of October, they have to distribute that net gain or net loss. No, excuse me, net losses they can carry forward. Net gain to shareholders. And so at the end of October, they close the books on the capital gains for the year. They total up the amount that they're going to have to distribute to shareholders, and then they communicate exactly what that's going to be. This year, looking at market performance, the markets have been up quite a bit. International stocks are up 8 or 10%. U.S. stocks since January 1st are up closer to 20, I want to say. And so that's going to produce some capital gains distributions from these mutual fund managers. And so as investors, really the best way to handle this is just keep an eye on what you have in your portfolio. And if it's a position that you just bought, maybe at the beginning of October, the portfolio manager is not able to discriminate between investors and send capital gain distributions to some investors that have held the shares for a long period of time and not other investors who've not. They have to distribute the capital gains pro rata to all shareholders no matter what. And so this is kind of a crummy scenario. I mean, think of it this way. If you buy one of these mutual funds in October or September, you've held it for a couple of months. Now, all of a sudden, some of these funds are required to distribute 15 or 20% of the net asset value in terms of a gain. That's not good. You probably don't want that to happen because you've not held the position for long enough to enjoy the appreciation and that gain in the first place. Maybe that, if you buy it at $100 a share, using our example, and the value of the fund, if you buy it in September, between September and the middle of December, maybe it goes up to $105 a share. It's very possible that you're going to get a taxable capital gain for, $15 a share. And it's not a very equitable, or no, it is an equitable thing, but it's probably not what you had in mind when you bought the fund in the first place. So the moral of the story here is that it's important to just keep track of these things and know what your expected distributions are going to look like, because you do have options. Remember, they close the books at the end of October. They tabulate what the taxable gain distributions are going to be, and then they communicate that to shareholders really starting right now. And by the end of November, we'll have some distributions. The rest will occur through the month of December. And so if you're holding on to a fund that is going to distribute a whole bunch of capital gains that you don't want, you do have the opportunity to sell the shares prior to that happening. And so way back when, say 50, 60 years ago, there would have been a whole lot of arbitrage opportunities surrounding this. And this works for dividends too. If you have a company that's trading at $100 a share and they're going to distribute a $2 dividend to each shareholder, or for each share of the stock, well, if you knew that was going to happen, you would probably want to buy shares of the company right beforehand and benefit from that if the company was trading at $100 a share. But remember that the age-old accounting equation of assets equals liabilities plus owner's equity, as soon as that dividend distribution is paid and recorded, the value of the company goes down by $2 a share until they have the opportunity to earn that back in subsequent quarters, subsequent years, and bring up the value of the equity again. Exact same thing with mutual funds. So it's not like you're missing out on the capital gain distribution and are just not ever going to get that back. If you're in a situation where you own a fund that's worth $100 a share and you're expecting a $20 taxable capital gains distribution, well, if you sold it before receiving that distribution, if the fund is at $100 a share, right after the capital gains distribution of $20, it's going to be trading at $80 a share, because that's simply the way that the math works. They can't distribute all that money from the portfolio and then not have the price of the portfolio move. That's just the math and the accounting of it. So if you hold one of these things that is about to distribute a large taxable capital gain, you have the opportunity to sell. You just need to pay attention to what's in your accounts. And if you are expecting a gain, do you want to deal with that or do you want to sell beforehand? Because if you sell, again, that could trigger a taxable gain to you on its own, but you will have the opportunity to buy the same fund back after the distribution and the net asset value has accounted for the hypothetical $20 distribution. Now, I'm getting off on a tangent there a little bit, but I hope that example makes a little bit of sense. As I mentioned earlier, active mutual funds tend to have this problem a lot more than passive mutual funds. And that makes a whole lot of sense to me, because using the Russell 2000 example, if you're adding companies to the portfolio, well, let's back up. Let's use an S&P 500 example. If you're adding companies to the portfolio, it means that they're growing in value. And when companies are growing in value, you add more of them to the portfolio because it's a cap-weighted index. The larger the size of the company, the heavier, the larger the portion of the S&P 500 that company represents. Therefore, the larger the portion, the holding in the portfolio. You're only going to sell those positions and sell the companies when they are falling in value. So it's less likely to trigger a capital gain because you sell things as they fall, which is more likely to trigger a loss than a gain. You're adding to the portfolio, buying it as it's going up. Now, same thing with the Russell 2000. It's also a cap-weighted index, but it's the lowest, it's the bottom 2,000 companies by cap size in the U.S. market. Now, active funds don't necessarily do it that way. And there are several notorious offenders for this, and we'll link in the show notes to a really good article from Morningstar I came across, where there were maybe a dozen or 24 mutual funds that just announced they were going to have 20% capital gains distributions to shareholders. And that's a pretty tough pill to swallow, especially if you're someone who's just recently bought the fund and haven't seen that 20% appreciation in your investment, and now you're going to be saddled with this big tax bill. That's really the situation I would look at, by the way, to decide when to sell a mutual fund before receiving one of these distributions and when to hang on to one. Yes, it is a little bit of backward-looking bias, perhaps. It's kind of a sunk cost, I guess, is another way to look at it. But if you buy the fund when it's at $80 and then it goes up to $100 over the next year or two, it's a lot easier to stomach one of these distributions than it is if you buy it in September at 97 and then it goes up to 100 over the next 6 weeks, and then you get a $20 taxable distribution. That's a much tougher pill to swallow. So those are a few things to consider. Really, the takeaway here, I think, is If you own mutual funds in a taxable account, particularly if they're active funds, just take a look at them and determine whether you're comfortable with the upcoming distributions or not. Exchange-traded funds are required to distribute short and long-term capital gains, but it's a much different animal. And while we're on the subject, let's review exactly how exchange-traded funds are put together. With the mutual fund example that we used, you and 9 other investors all have 10 shares of this fund. It's trading at $1,000. Your 10 shares are worth $1,000. Excuse me. If you want to sell shares or if you want to buy more, you transact directly with that mutual fund manager, who does the exact same thing they did when you bought the shares in the first place. They wait until the end of the day, determine what the portfolio is worth, and then either give or receive a commensurate number of shares in exchange for cash with you and any other investor who wants to trade with them. And they're required to offer that on a daily basis. With an exchange-traded fund, it's not based on the value of the holdings quite as directly. For the S&P 500 fund, use this as an example, but it's the same idea across all ETFs. You've got this basket of securities that the fund is supposed to represent. And it's more of a market-based product based on supply and demand, where you have what are called authorized participants creating and destroying shares of the fund on behalf of the provider and on behalf of investors and for their own benefit. Because when you buy shares of an exchange-traded fund, you're not buying them directly from the provider. You're buying them through an exchange. That's why it's called an exchange-traded fund. You're buying it from someone who's selling it. And the price of the fund is just based on supply and demand for shares of the fund. It's correlated to the underlying holdings in the S&P 500, but there's no direct link. And so if you have a whole bunch of people who want to buy shares of the ETF, and you don't have a whole lot of people who want to sell them, then that's going to drive the price up beyond the point where the corresponding number of, or the corresponding value of the underlying holdings would really justify it. So here's a similar example. Let's say that you want to buy shares of this S&P 500 fund. It's trading at $50 a share, but you total up what you would actually own, and the corresponding value of the underlying holdings is only $45 a share. You'd say, well, why on earth would I ever pay $50 when what I'm holding is only worth $45? And that's the exact math that I would go through. It doesn't make a whole lot of sense. Well, the whole idea with these ETFs is you have this group of authorized participants, is the quote unquote, it's the terminology, and they're basically trading desks on Wall Street that have the ability to create and destroy shares. And if there were that kind of discrepancy, well, the Wall Street Bank would sell a whole bunch of shares of the ETF. They'd probably go short. They would buy the let's make a simpler example. They would go to the market and buy each of the 500 companies in the S&P 500, and they have the authority to package them together, put them in a trust somewhere where some custodian hangs on to them, and then use those securities as collateral to create shares of the fund. And so if it's only going to cost them $45 a share to buy the holdings, and then they can sell the equivalent security that they can kind of create out of thin air for $50, well, they just made $5. And so because there's that activity going on all the time, anytime there's a deviation between value of the underlying holdings and what the ETF is trading for over the counter, or through the markets, I should say, then there's an opportunity for them to make money, and they do. And it's a price stabilizer and kind of create some guardrails to make sure that dispersion, that difference, never gets too big. Now, let's take the opposite case, just to, and I don't want to beat a dead horse here, but just to make sure that this all makes sense. Let's say that the ETF is trading at $45 a share, but the underlying 500 companies are worth $50 a share. Well, what the authorized participant would do is go buy a whole bunch of shares of the underpriced asset, in this case, the ETF. They would destroy them because they have the authority to do so as an authorized participant. And when you destroy the shares, you receive delivery of the underlying holdings that are held away at a qualified custodian somewhere, and then they go sell those on the open market. So it's the system of checks and balances that just makes sure that the price is stabilized. And because that's the case, you don't get as many of these long and short-term capital gains distributed at the end of the year. It does happen from time to time, but the magnitude, the size of them is typically quite a bit smaller than what you'll see in mutual funds. You'll also see in mutual funds large distributions when there's a lot less interest in the fund, meaning that investors want to sell shares and the holdings of the portfolio must be liquidated to satisfy those redemption requests. So remember, you've got, in our example, yourself and 9 other investors. Let's say that 6 of them want to get out and redeem their shares. Well, the mutual fund manager is required to satisfy their redemption requests. So in order to give them their money back, they're going to have to sell a whole bunch of the underlying holdings to raise the cash. Well, guess what? All those sales are going to trigger more capital gains that are distributed to the rest of the shareholders that are left after those 6 depart and redeem their shares for cash. So if you have a fund that's actively managed, it's probably more likely to distribute gains in the first place. But if it's not going so well, you have poor performance. Typically, that leads to more redemption requests than you would see otherwise, which will in and of itself trigger more capital gains distributions. So it's kind of a chicken and the egg thing. But once that starts, if you have a really poorly performing fund that's relatively expensive in this day and age, you can downward spiral very quickly. So your mainstream fund managers are usually pretty good at minimizing these distributions. Your index fund managers typically don't have to quite as much just because of the composition of the portfolio, the way these things are structured. But like I say, there are a couple dozen consistent repeat offenders, if that's what you want to call them, who just consistently have had to distribute a sizable amount of capital gains. So we'll link to that in the show notes. But I wanted to cover this on the podcast today because I'd say a large portion of our client base at the financial planning firm, we go through this annual exercise where we just do a tax projection and see where we think they're going to fall at the end of the year income-wise. Because if you're in the 24% bracket and it's the last year you're ever going to be in the 24% bracket before jumping back into the 32, well, it's kind of an opportunity there to trigger income this year at 24% rather than potentially paying 32% down the road if that's the situation for you. So it's helpful to know all that. It's helpful to know where you're going to fall. And we just need to be cognizant that there might be some distributions coming down the pipe because, as I say, this is the time of year when that kind of stuff happens. All right. That's it for this week on the podcast. I hope this wasn't too redundant, but it's a good annual reminder just to know what you've got in the portfolio, know what's coming down the pipe, and manage accordingly because you do have the chance to sell before these things are actually distributed. All right. Have a good week, everybody, and I will talk to you soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.